There are a few things that make me feel really good about the market, and there's a little bit of that in general push and pull. We talked about the wealth accumulation, how powerful that has been over such a short period of time. We talked about moving on from the election and actually having some enthusiasm following the election, and just that huge bump in future expectations, seeing that conversion, which is very unusual in history. But we also think there's other factors we need to be keeping that close eye on. We spent a lot of time talking about the Federal Reserve and the Bank of Canada. What is going on with their policy? Do they follow what they're forecasting? Do they have to pivot? What is the impact on interest rates? We talked about supply. Resale supply in some markets, probably markets that you're operating in, has shifted. Don't ignore it. Pay attention to that supply. How competitive is that supply? Is it a similar price point? Is it similar square footage? Could it pool from your overall sales? We're finding not only is there more competitive supply, but also tracking out those days on market. Has it shifted up? Has it gone past normal, or is it looking more similar to 2019? Asset values, economic trends, consumer confidence. To me, these are all things that can help us really understand the forecast of where the market goes as we think about 2025 and beyond. So with that, Tim, let me bring Zonda. If you're not overly familiar with Zonda, we are a housing data and consultancy firm. We track the entire building life cycle from raw land all the way up to the closing out of new home communities. Now, as you heard Tim mention, within my role at Zonda, I also run our economics department and all of our published research reports. These reports include national outlook that looks at trends across the U.S. housing market. We're looking at building products, the impacts of tariffs on building products. We're tracking out the build-to-rent market as well as master plans. Now, for today's presentation, I have 30 minutes to get through 5 sections. Now, you heard it. There's almost equal mix of class from U.S. and Canada. So if you are Canadian, we will be covering Canadian trends today as well, not just U.S. We're going to start by looking at the economic backdrop. And from there, we'll look at home sales and supply in the U.S. market. We'll talk about home sales and supply in Canada, what we're seeing with trends in confidence and wealth, and then finish with our final thoughts. So where I want to start with the economic backdrop is to just check in on the core data sets. If you listen to policymakers, both in Canada and the US, they will tell you they're looking at the totality of data, but very importantly, they're focused on what's happening in the labor market and what's happening with inflation. So these are going to be the 2 trends that we're going to focus on here today. Starting with the unemployment rate and labor market trends. As you look across both countries, we have seen a rise in the unemployment rate, which is completely to be expected given what has happened with short-term borrowing costs. In the US right now, the unemployment rate is coming in at 4.2%. Where this puts the US is 30% below our historical average. So we're certainly up from the trough where we had a 60-year low in the unemployment rate. 4.2 in the grand scheme of things is still very healthy. If you look at total employment in the US right now, we're 8% above pre-pandemic times. And if you listen to the words that Jerome Powell is saying about the labor market, he will say that he doesn't want to see more slowing in the US, but he does still believe the current backdrop represents a market that is at or near full employment. If you turn to Canada, it's a little bit of a different picture. Now, the first thing I want to acknowledge is you cannot compare the unemployment rate in Canada to the US. This is apples to oranges, but you can compare Canada to itself. So a 6.7% unemployment rate, where that puts the market is just down 11% from that historical average. If you look at the chart behind me, look at the gray line, which is Canada, there has been a steeper slope. There has been a more quick rise in the unemployment rate north of the border versus south. Total employment, though, is actually exceeding U.S. trends, up 11% compared to 2019. The big driver behind that is, of course, immigration. But if you think about the Bank of Canada and the words that are coming out of their mouths about the economy, they will say things like, the labor market is soft, the labor market has stalled, the labor market is slow. There's certainly more concern when you think about the labor backdrop in Canada than the U.S., and that plays into rate trends that we'll talk about in just a few moments. But high level, as you look across both the countries, what we could say is there is this growing but slowing economic backdrop, at least when it comes to the labor market. So then we want to say, okay, what is happening with inflation? Now remember, the way that people view inflation is a different way than economists view inflation. People think inflation just means pricing. And people will say pricing is expensive. You go to the grocery store, everything costs more money. Economists, what inflation actually measures is the rate of change. And what economists will celebrate is that yes, prices may still be high, but the rate at which they're growing has slowed down. Both of the central banks in Canada and the US are aiming for a 2% target with inflation. Both of the countries are at least heading that direction. Neither country has fully hit that 2%. It will be bouncy on a month-over-month basis, but we are generally finding that the inflation data is moving the direction that the central banks want to see. Now, if you think about the Bank of Canada, they have come out and they've directly said we're back in a low inflation environment. And the most recent press conference from the Bank of Canada, they said, we're back. Now we gotta hold it. And we feel a lot more comfortable and confident that in Canada, you guys will be able to maintain that lower inflation level as we go into the next year. If you think about the US though, there's more of a question about what that trajectory of inflation is going to be. That is because we obviously have a new administration coming in next year that's pro-growth. Stronger economy should be good for us in the room, but it also generally corresponds with higher inflation. Higher inflation corresponds with higher interest rates. Now you step back and you go to those two data points and you say, okay, if we're looking at a growing but slowing economy, it makes sense that both countries are trying to get out of restrictive territory. Meaning right now, the short-term borrowing costs are intentionally slowing growth. The central banks want to get to neutral territory. They're not trying to slow growth or push growth up. Like we talked about with the labor market, we have seen more aggressive rate cuts in Canada versus the US. Makes sense with the stats that we went through. But as you look into next year, the estimates are that in Canada, we'll get to neutral. We'll get to neutral and be able to hold there. In the US, this goes back to what I just said, right now the Fed is calling for continued cuts next year. But if you talk to economists, if you talk to policymakers, that is a lot more in question. What the Federal Reserve does when they release their reports is they base it on today. They base it on the stats right now. The Federal Reserve will tell you explicitly, they do not speculate, they do not assume on policy. So if we do see pro-growth policies, they will change their path in real time. They will not forecast to us that they think they will change the path in the future. Now, the reason we start the discussion, though, looking at the economy and looking at the central banks is because all of this ties to mortgage rates. When you look at mortgage rates in Canada, you have found a pretty standard path. Bank of Canada's cutting rates. Mortgage rates have gone down ahead of them, and they've gone down in response of them. You've seen both of that play out. You can see, again, we'll be bumpy on a day-to-day basis, but in general, trending down. But where this puts us is still at the same point, interest rates still at that highest level we've seen since 2010. If we think about the two countries, the one country that we care the most about with interest rates coming down will be Canada. In the US, we have 30-year fixed rate mortgages. The current homeowners that already have their home do not worry about what has happened with interest rates. In Canada, when you have a 3 or 5-year fixed rate mortgage, we know that at a certain point in time, 80% of all Canadians thought they might default on their loan. They thought they might default because they locked in a very, very low interest rate and they were coming back into the market and there was a big payment shock. So to me, this is good, seeing the interest rates follow right in line with what you see with policymakers. But then let's look at the US, because the US, there have been much, much more volatility. Before the Federal Reserve had even cut rates, we saw interest rates move from 7% to the low 6s. This was great. We were celebrating the idea that borrowing costs had come down, and the anticipation was that they were going to continue to come down. And then we saw a complete reverse. We saw that interest rates went back up to 7%. Now, as we look at the data, we see interest rates are coming in the high 6s. For a lot of people that just passively follow the interest rate, or for consumers, none of this makes sense. Because we know that the Federal Reserve has cut rates. And like we talked about, they're telling us they probably will cut rates more. Well, as you look at this, remember that the Federal Reserve is changing short-term borrowing costs. That is not the same as mortgage rates. Ultimately, investors drive mortgage rates. They drive where they are, they drive where they're going. Investors will step back and say, what is happening in the economy? Where do we think the economy is going to go? And they will guess, they will speculate on policy, and they will allocate their funds accordingly. That is why we have seen interest rates go back up. Now, there's a few wild cards that we're watching in the US, and I want to make this very clear. This is not a political statement. We had this slide before the presidential election. What we gathered from the Committee for a Responsible Federal Budget is that no matter who won the presidency, we were going to see higher debt and deficit levels. If you look at sustained levels of higher debt and deficits in one country, that does generally correspond with higher interest rates. We also already talked about as well the pro-growth policies that President Trump, or I guess Trump-elect, is trying to put into the economy next year. More pro-growth. Again, stronger economy corresponds with higher interest rates. So really what's happening now is this push and pull between monetary policy and fiscal policy and trying to figure out which one ultimately moves the market forward. Now, our forecast is still that we anticipate mortgage rates to be down or lower next year versus this year. But I will say at least some of these factors have put a little bit of question mark into how much we can ultimately see. But you step back and you say, all right, we've now spent 10 minutes talking about the central banks, talking about mortgage interest rates, talking about the economy. Why do we care? We care for one simple reason, and that's because it plays into not only consumer confidence, but what happens with borrowing costs also play into housing affordability. When you look at the US, we still have so many consumers that are sidelined in the market today. Either they feel uncomfortable with what is going on in the economy, feel uncomfortable with borrowing costs, or they're just trying to wait things out until they can feel that they see more certainty. As you look at existing home sales, this still represents the largest share of the market. Purple line is what we've seen so far this year, just bumping along the bottom. We see that existing home sales are down 25% compared to pre-pandemic times. A little bit of a lift in October, but really the key story is we have a very, very constrained, very tight existing sales market. We have, though, seen a difference. We've seen a difference when it comes to listings. So as you look at listings, again, purple is current. Every month this year, we have seen more inventory compared to what we saw last year. When you look at listings, they're up 26% compared to last year. But importantly, we still have nationally listings that are tight, listings that are still down 20% from 2019. But there's a big difference. When we met here last year, it was very easy to say everywhere, resale supply is tight. That's not the case anymore. When you look at resale supply, you have to say, then where are you talking about? And that's what this map is tracking out. The darker the purple, the higher the change in listings. If you can't see it, let me just tell you, it clusters. Here in Florida, parts of Texas, parts of Arizona, parts of Colorado, parts of Utah, we have higher inventory today compared to 2019. That is a huge shift. We did not see that 6 months ago. If you're operating in California, in the Midwest, in the Northeast, we still have inventory down 20, 40, in some cases 60% compared to pre-pandemic. But then you say, okay, well, that's looking at the overall market. How does this look if we're thinking about luxury homes or we're thinking about the high-end market? Well, we can get access to this data too. And I thought maybe we were going to find some unique trends, but the answer was no. If you look at the high-end market, it's the same areas that are posting the most dramatic increases in listings. That's going to be parts of Florida, parts of Texas, parts of Arizona. Now, when you track out listings, and the reason we need to spend time on this is historically, if you look at the relationship between listings and sales, when there is a higher level of resale supply, it does generally correspond with a lower level of new home sales. Now, there's a lot of caveats to that, and I'll show you new home sales in a moment that could say that, hey, we're bucking the trend. But to me, we can't discount that the market dynamics are shifting compared to what we're used to over the past few years. Now, we've had some of our clients say, I'm confused. I thought everyone had locked in a low interest rate. No one wanted to move from their home. Well, yes, we still have the lock-in effect in a lot of instances. You still have 80% of people that have locked in a rate under 5% in the US. But in some markets, property taxes have become an issue. In some markets, it's insurance costs or availability. And I think in a lot of cases, people thought 3% interest rates were going to come back. And they were waiting. and they were weighted. Now we've gone a couple of years where interest rates have held at that higher level. Time to move on. If you got married, if you've had a first child, a second child, if you've gotten divorced, there's other factors that are more powerful than an interest rate. But like I said, historically, if resale supply goes up, you do see a pullback in new home sales. Right now, we're not seeing that play out. This is showing new home sales by month by year. Purple is 2024. So notice that yes, as we go later into the year, we have seen sales pull back. We're a seasonal industry. That's exactly what should happen. To me, I like to compare out the most recent data to what kind of year does this look similar to? Well, right now we're right in the middle between 2021 and 2019. To me, that's a really good place to be. That's a place where it shows a healthy, pretty well-functioning overall housing market. But we need to take this a step further because we're looking at overall sales, but at Zonda, what we like to do is look at sales adjusted for supply, look at sales adjusted for seasonality, and look at how it varies across the country. So nationally, we have a slightly overperforming new home market. That is 10 months in a row where we've been slightly overperforming. As you would imagine, any of the green dots on the map are overperforming. Yellow will be average, red will be underperforming. One thing I do want to acknowledge is that with this index, we do not adjust sales for incentive usage or for effort level. How hard is it to sell a home today? We don't care. We're just looking at, do the incentives that are being offered, does the education that is being communicated to the consumer actually result in a change in sales? A lot of markets, the answer is yes. But then you need to break this down a step further. Because if you look at sales by price bucket, the entry-level market by far is the slowest. To me, this makes sense. You have someone that is looking at a monthly payment, someone that's looking at rent versus own, someone that's looking at an interest rate. And they're basically saying it doesn't make sense, or I can't financially make the market make sense for me to buy a home. We are finding the strongest sales right now stem from the higher price points. We're finding higher sales in the move-up market, also in the high-end market. But this makes sense. If you look at spending in the wider economy, there's data from the Federal Reserve that says lower income folks, they have increased their spending by 8% compared to where we were going into the pandemic. Higher income folks, they're at 17% of a rise. You're seeing that there is that rise in spending corresponding to rise in the housing market as well. We'll talk about wealth. We'll talk about confidence and the distribution by income level a little bit later. But I also just wanted to show you how this map looks if you just look at the high-end market. Again, green overperforming, yellow average, red underperforming. As we look at the high-end market across the country, that'll be the top third in any given market. We do not compare price points market to market. So LA's top third will be different than Miami's, which is different than Orlando's. As we track this out though, again, similar to what I said earlier, it doesn't mean that sales are easy. We know that days on market are ticking up. We know that the market has become more work. It has become a bit harder. But in a lot of cases, we're still seeing sales match what we would expect this time of year. Now, if we take that and say, all right, how does this compare to what we've seen in Canada? Well, we've actually seen a very different trend. Where we talked about how the Bank of Canada has been more aggressive with the rate cuts and we have seen a more direct response with borrowing costs. We've also seen a direct response from consumers. We now have 4 months where you have seen sales improve following the rate cuts. We're finding now that the red line is above the black line. Notice that we haven't seen that since rates started going up in 2022. We've seen an 8% increase in sales on a month-over-month basis. Sales are coming in at the highest level in 2.5 years. And 2 markets are really leading the growth in sales in Canada, Toronto and Vancouver. To me, this makes a lot of sense because when you look at interest rates as they go up, those 2 markets will get hit disproportionately worse than other markets. As interest rates go down, you also see the positive impact on the other side. But different than the US, where you have sales up and supply up. Remember, in the US, you have supply up without sales up. In Canada, you have both of them moving together. As we look at overall inventory, we do see right now in Canada, there's the highest level of absolute supply dating back to 2022. But then we want to say, okay, how does that supply look if you adjust it for sales? What is the months of supply? So right now we're at 3.7. Canada's historical average is 5.1. For the majority of this year, the market was operating at 4 months of supply. 4 puts the market right back to where we were in 2019. So to me, we're seeing this return of some healthy levels of activity across Canada. But then you want to think about the high-end market. And so I pulled this quote from Sotheby's CEO talking about this fall. What are home buyers and what are investors going to face? And they're saying some of the most favorable conditions when you think about the high-end market, because there has been a little bit of a compression in price. We have seen interest rates go down a bit. We have seen that rise in supply. All of a sudden, the market feels a little bit easier to navigate than the environment that we've come from. Now, in Canada, we do not have the equivalent of the ZMR, but I wanted to at least show you the breakdown of buyers. I'm talking about differences by income level, talking about wealth and how that plays into overall consumer confidence. So this is now going back to the US. We're looking at a survey from the University of Michigan that's just looking at how do you feel about the economy today? This is looking at the top third of incomes, which is purple, middle third, which is gray, bottom third is going to be your green line. Now, there are different points in time where the top third will outperform the others. You can see that on the chart. But what's unique right now is this prolonged stretch of the higher income folks in a given market that are saying, I feel good about what the backdrop is today. But there's another way we need to look at this. So this is current. We're going to now look just at the top third of incomes, and we're going to compare out how they feel today, the green line, and what they think might happen in the future. That's the purple line. As you look at this, I want you to notice the most important trend that we're capturing. There's an inversion. This does not happen often, but what you are finding is for higher income folks, they're more enthusiastic about what the future holds versus the reality today. But again, remember, the reality today is stronger than any other income level that we're tracking out. Now, to me, I think this inversion makes a lot of sense. Part of it is there was a lot of wait and see. What is going to happen with the presidential election? And by the way, from a lot of the things that I read, this was not just an American phenomenon. We saw this happen in Canada too. A lot of people stepping back. What's going to happen? Well, now, if you think about higher income folks, there's a talk of tax cuts. There's a talk of pro-growth policy. And there was a decisive winner. We knew the day of the election who was going to be the president. And so at this point, you have people that say, okay, now at least we have certainty. Now at least the next 4 years, we have a better sense of what's to come. It's time to move on. But I want to go back to the idea of current, people feeling good about their current backdrop. And to me, this ties down to wealth. If you look at how much wealth has been accumulated just over the past 5 years, let alone the past 20 years or more, these numbers are astounding. In just 5 years, if you look at the S&P 500, we're using this as our proxy for the stock market, up 90%. If you look at the TSX, we're looking at a 50% rise in the past 5 years. To me, what you have to remember about this is the only way that you're going to benefit in the rise in these stock values is if you already own stocks. And we know that that's going to contribute to that gap between the different income levels. But if you don't just look at the investment portfolio, you also just look at housing. This is showing you home price growth compared to where we were in 2019. Similar to the other map, the darker the purple, the higher the change. So here in Florida, no surprise, lots of dark purple, high levels of home price growth over the past handful of years. Southeast, Southwest, California. If you look at the US as a whole, we've seen home prices go up almost 65% compared to 2019. In Canada, we're looking at home prices up 50% from 2019. And what that translates to is trillions of dollars in equity. In the US, the amount of equity that has been accumulated nationally is equivalent to 40% of the US GDP. These are huge numbers that we're talking about. That can be tappable equity, but also plays into the wider overall wealth effect. Now, similar to what I said with stocks, though, you can look at the growth, you can look at the change, but then you have to step back and ask yourself, well, who is going to benefit from this? If you think about home ownership, the Gen Z have the lowest home ownership. They're a group that has told us they want to own homes. They're a group that's going to struggle the most financially. Millennials, you'll get to a 50-50 home ownership rate with millennials. You get up to Gen X, you are finding that higher home ownership rate, baby boomers will be the highest. We know that the propensity to own and the ability to own goes up with age, Across both nations, actually very similar trends. We have about 65% of households that already own a home. But when we have to step back and say, all right, baby boomers today control the highest share of wealth, they control the highest share of equity, and they are parents to the millennials. We know 72% of boomers are planning to give some or all of their money away while they're still alive. So you think about the wealth accumulation. We can talk about the affordability challenges and the economy, but we also need to stop and focus on that wealth transfer. That wealth transfer is going to be such a big part, in particular, of the high-end market as we think about what unfolds over the next 5 to 10 years. When this is talking about people that own homes, I want to do one other slice of that, which is if you look at home ownership, 40% of people in both Canada and the US own their home free and clear. So in their case, when we talk about the lock-in effect, you have 40% of people that say, I don't really care. I don't have an interest rate that I'm resetting, but I do need to have something powerful in my life that ultimately makes me want to go through a move. The last group here I want to talk about is just looking at international migration. I'm going to put it in the dotted line here, which is 0. As you look across all of these markets in the US, you can see all of them have been positive since the year 2000. More people moving in than moving out internationally. And the first thing, and maybe you guys did too, when I saw this chart, it said, holy Miami. That is a wild increase in the most recent data. In order, you see Miami coming in as number 1, Boston as number 2, San Francisco coming in as number 3. Now, Kimberly Byron, again, you'll hear from her. Her and I were talking about the dollar, and we're going to be tracking what happens with the dollar's strength under the new Trump administration and how that plays into this. But to me, it's a huge subset of the population that has a little bit less sensitivity to mortgage rates, when in a lot of cases they're not using a loan at all. Again, if you think about US versus Canada, this has been interesting. So in the US, lots of talk about immigration policy, but the talk is on deportation of undocumented immigrants. It's not on individuals that come in that are likely going to buy a high-rise condo or live within the market. If you think about Canada has had a different stance on immigration in general, much more open to temporary or permanent people coming into the country. But now, of course, as we've seen the cost of living go up from owning and just general costs, you've also seen that Trudeau has come out and really shifted the tone and said, hey, we're going to change our immigration policy, at least over the next couple of years, allow the economy to catch up. Not only a little bit of a shift on immigration, but also a lot more policy intervention in Canada versus the US on who can be buying homes. Do we want investors buying homes? What kind of caps do we ultimately have in the market?